Welcome to One with the Other Way, a podcast about your journey and finances. I'm your host, James. Today we have Wanda with us. We're having a special episode on credit scores. We had recently filmed a podcast on credit cards. So if you haven't already checked out that episode prior to this one, I highly recommend that you do. You can then kind of follow up in this one as like a part two of sorts. So today we're talking about credit scores. Wanda, do you kind of want to hit it with like the main takeaways that we're going to start with?
Let's have three main takeaways, I think. What are credit scores? How are they calculated? And are they important? And are they important is going to be, I think, my favorite part of the topic.
So let's kind of go into what they are. The definition is a number regarding a person's credit worthiness as defined by numerous factors, and we'll get into those factors.
Yeah. So I want to do a little bit of backstory. Credit scores actually started in the 1840s, and they were actually created by the Mercantile Institute to give credit worthiness to companies, whether they wanted to lend companies money. And they included things such as marital status, ethnic background, and credit history, and moral judgments. And they were kept in a ledger in New York City back in the day.
Wow.
So we're looking at racial background, gender, and moral character as rated by a credit agency back in the 1800s.
I don't think that would fly today.
Yeah, no, never fly today. But it developed because then department stores started to grow across the United States, and then they wanted to determine whether or not they wanted to lend people money so that they could buy their goods from the department store, and they developed their own credit scores, which sadly in the early 1900s, late 19th century, were not much different than the Mercantile Institute with those kind of subjective characteristics. And actually all the way into the 1960s, there were over 2,000 credit scoring agencies across the United States rating you, giving you a numerical assignment based on these kind of subjective and objective characteristics.
Aren't there like three main ones today?
Right. Somewhere around there, then there was a consolidation in the industry. But imagine this, that the industry, the three main companies that are in play today was a consolidation from all those 2,000 companies. And they went around from town to town gathering those papers that actually rated your credit worthiness in those days and kind of pulling them together. This is in the 1960s. So I was around back then, James, maybe not you, but so it's a consolidation that right now we have three, and the three big ones are, as we know, Equifax, TransUnion, and Experian. Those are the major three. But again, coming from the 60s, consolidating and looking at papers, now we've gotten more objective, and that's to our second point of what exactly is a credit score. We want to have disclosure, and sometimes they use the word transparency, yet you're never going to know all the details. But basically, they're looking at things like your payment history. And the suggestion is about 35% of the score is weighted on your credit history. 30% of the credit score is weighed on the amount owed. 15% is on the length of the loan, like how long have you had the credit card open. 10% is how much new credit you've gotten recently, if you're getting a lot of new credit recently. The last little bit has to do with the type of credit, whether it's an installment loan like a car payment with a fixed end or a variable or a mortgage. Those are actually rated differently. But even as you think about each one of those five categories, each one of them has a subjective call. How long is the length of your credit history? Is 10 years a long time to have a credit card? Or is 11 years a long time?
I don't know. That's a good question.
Mm-hmm. So the credit agencies are making subjective calls on what they determine the length of the credit history. And, arguably is 11 years that much different than 10 years? But there's some line there that you and I don't see. And the other thing that I hear a lot coming from TikTok world is the amount of credit that you're using. So in other words, if I have a $10,000 credit limit, utilization score. And the suggestion is that if a utilization score is lower, this is a good thing. Not necessarily.
That's what I've heard as well. I know the big two that I've heard were your on-time payments and then the amount of credit you have. But yeah, something that I feel like I've been hearing more recently was just like, yeah, you want to make sure your utilization stays under a certain amount. So you're not maxing out your credit limit.
Right. But if I owe $2,000 on a credit card and my credit limit is $10,000, right? But then I owe $2,001, then I'm in a different objective category or subjective category, depending on the credit agency. The most important thing, as you say, is your payment history. Are you paying your loans on time, and are you managing the payments of your loans?
We know what kind of factors influence the credit score.
Mm-hmm.
Kind of getting into more of the how important are they? Like, do you need a credit score for things? What do you use a credit score for if people that aren't aware of it yet?
You're getting into one of my favorite categories, is how important is it? I will tell you that in the years that I've done financial planning, we used to never talk about credit scores. And now I think that pretty much comes up every appointment. People are very proud of a high credit score. Maybe they want to ask how to have a better credit score if it's a lower credit score.
Well,
And
let's start with what's a good credit score then?
so I think before we talk about what's a good credit score, there's a range, right? Somewhere I think from 300 to 800, right? Higher to closer to 800, you're going to be in better
I think it's
shape. Closer to
850
300,
now is the
yeah,
top.
850, right? So higher to 850 is better, and then lower is worse. So there's the subjective range. 800 is better than 799 categorically. If you're in the 700s, that's worse than 800. But how much worse is 799 to 800? I think I want to suggest that there's a lot of emotion because it's a grade. It's a grade that you as a human being are getting. Hey, I'm running around in town and my credit score is only like 450. And what's your credit score? And it's marketed and pushed that you are good if you have a high credit score. And if you don't have a high credit score, we need to help you get there to have a high credit score. I think this is well marketed by the credit agencies. Back up a little bit as to why we use a credit score. A credit score is used to determine credit worthiness for a prospective client, or how much risk the bank is going to take if they lend you money.
Mm-hmm.
And so that's not the first thing the bank's going to look at generally. The first thing the bank is going to look at is, do you have income?
Yeah.
Yeah. And then they're going to look at, on your income, what percentage of your income is to debt servicing, whether it's mortgage, installment, or variable. They're going to look at those things first before they consider whether they're going to give you a loan. And then they'll give you the loan based on the risk to the institute, to the banking institute, based on your credit score. So you can get a lower interest rate.
Okay. Okay.
Yeah. And sometimes what they say they call more favorable products in the mortgage market, right? So they're not going to consider you for a loan unless you have the income to support the loan, and unless you have the amount of debt servicing is within their range. And generally it's going to, I find it amazing because they will actually approve you for a loan if you have a debt to income ratio of 45%, which is like, that means out of every dollar you're making, 45 cents is going to pay debts, mortgage,
Jeez.
credit card, or installment. That's a lot.
Yeah.
Mm-hmm. Yeah, yeah. Which we could do a whole nother thing about being house poor, because the bank can lend you a loan, right? Remember, the first thing they look at is, can you service the debt? Can you pay it back? They'll give you a loan where you have a debt to income, your mortgage payment and your taxes and your insurance is 45% of your dollar amount. But that only gives you 55% for everything else to include your taxes. Just think about that.
Yeah. I mean, it's interesting, like buying a home, for instance, and looking at credit
Mhm.
score. Do you even need a credit score to buy a home?
Yeah, yes, you in fact do need some kind of credit score. There's some talk on other podcasts about how you can get around not having a credit score. Um, Generally, it's a good idea to have a credit score. Yet you shouldn't put the cart before the horse in this case. You shouldn't be thinking about your credit score. You should be thinking about your financial landscape and what's important to you.
Do you see more often that it is flipped amidst the
Yeah.
current financial landscape, that credit score is more important than your financial
Ye
landscape?
Yes, and see, the financial landscape is much more important than your credit score, because the credit score is just a piece of the puzzle. Generally, it's used to determine the amount of risk the banking institute is gonna take, and so they're gonna assess a higher interest rate if your credit score is lower versus higher. You need a credit score, though, because in most cases, even a apartment rental agency is going to give you the property or the asset, the rental space, with a credit history. They want to see that you're making payments. They want to see that you don't have too much debt. So the credit score is important even when you're renting, and actually even for car insurance. So a lot of agencies are using credit scores. So because you're renting a space from them, the risk that they're taking, right, is that you won't pay the rent. And in not paying the rent, then they would be out financially for the space that you're in, when they could be getting rent from somebody else. And so there's that risk to them. But you can get around that. So sometimes people don't have a good credit score, right? Depending on the rental agency, if the risk to them is that you don't pay your rent, then you can have a higher deposit so that they know that if you're missing out on a rent payment or two, that they've got a backdoor here because you've put a deposit on it. And I've seen them request deposits as many as 3 months.
Sure.
Yeah.
So this kind of goes into, then we're talking about having problems with your credit score. How do you improve it?
If you find that you have a low credit score, normally there's a lot of agencies that are selling you the ability to get your credit score ahead of time. And then they're subsequently selling you on their ability to help you lower your credit score. Which I'm like, okay.
That seems like a gimmick.
Help you low. Yeah. And so I want to call them out, but I'm not going to call them out. But hey, find out what your credit score is, because you're somebody if you have a good credit score. And by the way, we can help you get a higher credit score so you can be somebody. So that mindset, I think, is an interesting mindset. So if you find that your credit score is lower than you wanted, you can get generally one free credit report from each of the agencies. And you should do that. So if you find that you have it, because sometimes you'll find that you have something on your credit report that you were not aware of. So I'll give you an example. A few years ago, I had a low credit score, and I was like, why would I have a low credit score? And it turned out that I had separated from the military like 5 years before. And for some reason, the military decided that I owed them half a day of pay. And instead of contacting me, they just put it on my credit history. so, so, so imagine, if you will, contacting the Department of Defense and saying, okay, so about this half day pay that I owe you, who do I pay that to? And can I just get that off my credit score?
Yeah.
So
I'm
okay.
surprised by that.
I know. So you never know. So pull your credit score, right, and see what's on there. And then that'll help you say, oh, that's what that is. And then decide what you need to do to fix it. So I share that story because that's like in an innocuous thing. You're like, really? The military? What?
Is
Get
it
the credit
easy to get
history.
something off of your credit report?
It is complicated to get it off, but it can be done. And the thing to do is to take a look at the credit score, see what's on there that's holding you back. Remember, if a third of it has to do with your payment history, take a look at your payment history first. See what you're doing. Are you missing something? Are you getting late payments in there? And then what can you do to fix that? And then you're going to need to have some more time of regular payments, non-misses, that kind of thing going forward. And then you have to be patient with that process. The other one is the utilization rate, as you mentioned before. And so what is your utilization rate? And then can you clean that up? Careful though, because sometimes you don't want to rob Peter to pay Paul. So you pay off a credit card, but then you're like picking up on another credit card. Step
Yeah.
back. Looking with a financial advisor is actually a good way to look at cash flow and say, hey, what's going on here in the cash flow? And let me carefully improve my credit score so that it can have a lasting impact on my life going forward.
We talked about the negotiation process with creditors. What about when like major life events happen, like divorce or job loss? Does that also impact your credit report? And do you need to talk to someone about like making sure stuff doesn't go on your credit report like that?
Right. Well, like divorce can get complicated sometimes because couples will generally have their finances tied together. And so you want to be mindful of that. In general, if a loan is made and it's a joint loan, it's generally the loan is credited to the person whose social security number is on the top. Just because I think the way the system goes, right? So, you can have a mortgage, right? Both of you are paying, both of you are working, but the person who's getting, air quote, the credit for it is the person who's on the top, which in our world, a lot of times happens to be the male, but that's just something to consider. So when a couple is doing financing, as they're financing together and they're getting a car loan, they're both knowing they're going to make the payments. That's a family thing. And then, alternating and making the lady of the house, or the other person with the lower income, the primary borrower, the institute's going to look that both of you have the income to support it. So that's probably not going to affect your ability to get the loan, but it'll allow someone to get some credit history. So divorce could affect it depending on how you've done your loans going into the divorce. Losing a job's not going to affect it, right? It's not one of the 5 factors. Yeah. And you said something about negotiating. You can negotiate for loans. And if you look at your credit score and there's something on your credit score that you don't agree with, then you negotiate with the creditor that appears on the credit score. And sometimes they will not change it, but you can do it.
Is this something that you would need to bring in, like legal assistance?
I hesitate to say to go to an attorney for something like that. If you're candid, open, and honest with your creditor, let's say there's a Home Depot thing on, I don't pick on Home Depot, but a Visa thing on there or a MasterCard thing on there. If you talk to that company directly and say, this is on my credit history, what's going on? And what can I do to remove that from my credit history? And they will work with you to do it. You have to find the right person. And you got to put some time on your calendar, and it is time consuming. And it's that place of judgment. And so then you're thinking, oh my gosh, I'm sitting in judgment again. So you have to let go of all your preconceived notion and stay present and not be accusatory and looking positively about how to fix it. So you can do some negotiation with those retailers and that kind of thing. And sometimes you can strike things off of your record that somehow appeared on your record, but should not be there, because there are mistakes that are made.
I know someone that happened to. There was something that actually wasn't theirs. It was someone with their same name, and it got moved to the wrong person.
Right.
Those things do happen. I have seen. So maybe going on hold for a while might not be a fun time, but it might solve those problems. So
practice your yoga exhale. It's all good.
So in today's episode, we talked about what are credit scores, how they're formulated, and if they're important or not. If you'd like to schedule an appointment with Wanda, you can find us at financesforreallife.com. You can also continue to follow us on the podcast on Spotify, Apple Music, and on YouTube. We produce every 2 weeks. So thank you for listening to today's episode. We hope you have a wonderful rest of your week. Securities offered through LPL Financial, member FINRA, SIPC. Investment advice offered through Finances for Real Life, a registered investment advisor and separate entity from LPL Financial. The opinions voiced in this podcast are for general information only and are not intended to provide specific advice or recommendations for any individual. To determine which strategies or investments may be suitable for you, consult the appropriate qualified professional prior to making a decision.